What is going on, investors? Hopefully, you guys are doing well out there. That's right. Welcome to the first of what I think is probably going to be the first of many interviews that I'm going to be bringing to this channel now that I'm a part of Legacy Research. The opportunity that I've had just over the past couple of months to meet with experts and executives and professional traders has been nothing short of amazing. And I'm going to start bringing some of this to you here on the channel. Today's guest, you're going to love this guy. Larry Benedict has been trading stocks for nearly as long as I've been alive. We're talking 40 years of trading experience. Larry started, I think, on the CBOE in Chicago, and he ran one of the most successful hedge funds for about 30 years. And here's the most amazing thing about Larry. He literally didn't have a losing trading year from, I think it was like 1990 all the way through 2010. And look, over this time frame, you all know what happened. We had the dot-com bubble that burst. We sadly had the 9/11 attacks, and we had the great financial crisis in 2008. The really cool thing about Larry is he's actually willing to share the strategies that have worked for him for this such a long period of time, no matter what the markets are doing. So on today's video, Larry is going to show you a specific trading strategy that not only works, but it's actually fairly simple to understand as well. He's going to give us some great advice on risk management and discipline, something that we talk about actually quite a bit here on the channel. So make sure you pay close attention for that as well. Sit back and relax. I hope you enjoy today's interview guest, Larry Benedict from LarryTrading.com. What is going on, investors? Hopefully you guys are doing well out there. I've got a very special guest on today's show that we could go on and on about Larry Benedict's illustrious history with hedge funds, trading. I mean, it goes back decades. But I think having an experienced trader like this on the show, the most important thing to do is pick his brain and get tips and insights that is going to help us as investors, help us as traders. And I brought Larry on today to really discuss a lot about some really more or less some beginning fundamentals as it relates to trading. Larry, thank you so much for joining us today. How you doing?
Oh, Colin, thanks for having me. I'm doing great. Everything is going well. Interesting year for sure. We're kind of mid-year now and coming into the home stretch. So it's been interesting, and I'm glad to be here and try to help whoever we can.
Yeah, absolutely. And it has been, it's been an exciting year, especially on the heels of last year where you had maybe one of the worst performing markets that we've seen in a long time. This year, you've had a nice rebound, particularly in the tech sector. But I tell you what, where I want to start is, there's a lot of people watching this and, maybe they got $1,000, maybe they got a couple $1,000, maybe they got $10,000, maybe they're doing really well and they might have $50, $60, $70,000. And they have in a retirement account, they've got their buy and hold portfolio, you know what I mean? But they want to do a little trading on the side. They sometimes see these stocks. We've got mega cap stocks up 40, 50, 60%. You've got stocks like NVIDIA that are up 200%, 100% across the board. It'd be fun to make some of this money kind of in the shorter term. I know that's where you've made a lot of your money and you've made a lot of focus over the last couple of years. I tell you what, if you were just starting out, and I came to you, Larry, and I said, man, Larry, I got $10,000. I want to put it into the market. Where's the first place you might direct me? Are we going to currencies, Forex, options, stocks? Where's the first place kind of a newer to intermediate trader should actually start if they're just getting down the road of trading?
Well, my focus started in the equity market. So I would say to anyone out there, the most stable, liquid market is equities. Obviously, currencies have more volume, but currencies have a lot of volatility and a lot more uncertainty than the equity markets. Obviously, the bond market is very, very big as well. But my focus would be in equities. And what's important, especially whether you're starting with $1,000 or $100,000 or whatever your number is, the most important thing and I always stress this, is to become an expert in either one, a sector, okay, whether it be technology, biotech, drugs, anything like that, and then drill down and pick 4 or 5 stocks max that you like a lot, and learn those stocks, learn the ins and outs. I mean, it doesn't have to go as granular as the balance sheet, but just watch the way those stocks trade, how they trade to the market, correlation, and all of that, and then invest or trade in 4 or 5 names. I think a lot of the problem out there for new investors or people trying to what I call conquer the market is they spread themselves thin. They get into too many names that people talk to them about at dinner, or they overhear somebody, and the natural instinct is to want to be there because Joe, told you about this, and Joe's telling you how much money he's making, and then you sort of lose your focus, and then you're spread too thin. So I would say to someone that's just getting involved, I would just start with stocks in the equity market. I would become very narrow, not broad based, and I would learn a sector. For me, it came down to when I started, maybe picking 2 or 3 stocks that I liked. I shifted my focus a little bit when I started, because even when I picked those 2 or 3 stocks, I was really picking the market per se. So I then shifted my focus to the S&P 500 or SPYs or SPX. But most likely for everyone out there, SPYs would be a good place to start. And that gives you a broad base 500 stocks to look at, but it's really one stock. And the beauty of that is that goes up and down every day, and that is the broad barometer of the market. What bothered me when I first started, I started a very long time ago, basically 4 decades ago. And IBM at that time was the Apple of today. And I would trade IBM every day because it was the most likely to be with the stock market. But then I got really, really upset because I thought that IBM would go up because the market was going up. And then some days IBM would be down when the market was up. And I said, listen, I want to solve this problem. So I basically started trading the OEX, which are options on the S&P 100, which is even tighter. So really, I think advice to people that are just starting is to be as narrow as possible, try to predict the market per se, and invest that way.
No, that's great. And I think that's great advice. Maybe start with a sector, like you said, that like makes sense to you, that maybe you understand well, maybe a sector that you already follow. And you kind of mentioned, indexes as well. You've got the SPYs, the S&P 500. There's certainly, an ETF for just about anything these days. So let's say I've narrowed my selection down. I've got 4 or 5 names that I'm familiar with. I know these companies, maybe I follow them every time they report earnings, etc. And I'm more or less comfortable with the 4 or 5 names that I'm going to trade. What indicators are we looking for that like more or less indicate this is a time to buy the stock? This is a time to get more interested. This is a time to actually put on the trade. What indicators are you using to help you make decisions on when to pull the trigger on a trade on the 4 or 5 names that you're looking at?
Well, I would say if you're sector specific, which is what we're talking, I would know those companies inside and out, how they react to the market. And the one thing that's a little tough, especially if your time horizon is inside of a few days, which most of our subscribers are, and we're putting on transactions almost on a daily basis, we need to be right that day or within a few days. So really, even if you have the right sector per se, it's really the market again. So we get back to the indexes, and I would say, you could pick 3 or 4 stocks in technology, but if you really want to play technology, probably a better way to play it is by buying or selling the QQQ index, which really expresses the technology sector. It's heavily weighted with I guess the 5 or 7 horsemen, the NVIDIAs, the Facebook or Meta, as they call it today, Apple, Microsoft, etc. Because the weightings of those stocks make up 60 to 70% of the entire QQQ. So really, you don't have to know those stocks like the back of your hand, even though you do. You just can play the index. So again, it's probably the best, safest way. So I would recommend ETFs potentially on the broad sector, whether it be QQQ, SPY, USO if you want to buy or sell oil, XLE, which is, and I can go on and on and on, but you can drill down to that. So rather than buy, let's say, integrated oils, you could just trade an index that replicates those stocks. And there may be 25 stocks in that particular index, but the weighting of Exxon, Chevron, etc., is most of that index. So you're getting the play for that by trading the broad-based index. And I think it's a really good pure play.
Yeah, no, and I like that. So let's assume we're trading kind of an index, and are you following the news on a daily basis? Like, for example, Apple's got an event today. Are you really caring a lot about when the next iPhone comes out, or are you focused more or less on the chart patterns and the different technical setups? How do you weight those two different things? Because I think a lot of people think like a trader is just looking at the price chart. They never look at a balance sheet. They never look at the news. But what I'm getting from you is you're actually thinking more about the sector, the news flow, and the trends in the news. Am I correct in saying that you're more or less also following the news, but is there also some technical patterns that you're also following from a chart perspective?
Sure. So, I'm lucky enough to have a few analysts that work with me, and we look at different things that we always look at. But, before we go to answer that, I would say this: price action really is the key. Okay, so all of the analysis you do on Apple, and maybe you think the product announcement is going to be unbelievable and they're going to come out with a phone that can beam you up to the moon, or whatever it may be for that time. If the stock acts bad off of that announcement, that would lead me to believe that the stock is not good. Fundamentally, it could be good, but it may be overowned. There's a lot of different things. So I would say number one is price action. So a lot of mean reversion, which means what it says is if it's overextended to the upside or the downside, we believe it, eventually will come back to the mean at some point in time. But we do a lot of technical and fundamental analysis, but we let the price action dictate to us. So, looking at Apple today, for example, they're coming out with new products, and, the stock actually acted very strong yesterday into the announcement. And today it's not acting well. So we're kind of confused because we probably think it may go higher or take a little bit of a leg higher here, but it acts very heavy. So we got to be leery of price action. So again, price actions number one. Announcements or news is very, very important. Fundamentals are extremely important as well as everything else, but price action is really what we look at.
Yeah, that's interesting. And I think a lot of people get the sense that if you're a trader, you're not an investor, and you don't have to worry about the news flow. But it's refreshing to hear from you, Larry, that you're actually following all of this. You're kind of taking it all into account. And you mentioned something called mean reversion. Maybe let's dive into that a little bit, and how you analyze that, maybe like on a time frame. Are we talking about mean reversion over a certain like a short period of time or a long period of time? Maybe walk me through like a mean reversion kind of technique or a trade
Sure.
that
So
that you have.
Sure. So what I like to do is I like to play trends. So not really go against the trend. So if I believe the trend is higher, but a stock is overextended. So let's use Apple. Let's say the stock is $178. It goes up to $185. We believe that the trend is higher, okay? But we want to wait for it to mean revert. And as it does, we want to try to get long that stock because we believe it's still in an uptrend. We don't want to buy super strength because we think potentially it's overextended. So we wait for the stock to come back in and mean revert, which means come back around to the original price. So if it goes up 20% or 14% and it comes in 7, 8, that's a really good mean reversion trade for us, meaning that we would look to buy that as long as all the catalysts are in play and everything looks the same. So, in our thought process, we believe, with a little bit longer time frame, everything comes back to the mean at some point in time. Now, as you guys, everyone out there saw in GameStop and AMC, a lot of large hedge funds play the same type of game where they believe the fundamentals weren't intact and it was going to mean revert, and they basically got their head ripped off. So, we're not looking to really short a situation like that, but we would buy once that thing came in that case, a lot, because it went up thousands of percent. So, we're not looking as a mean reversion to fade that move or go against that move. We're looking to jump on board that move when we get the stock that comes back in a little bit.
I see. So is it fair to say, so you have a stock where the momentum generally is going up. It might be a little overextended, maybe like an Apple or an Nvidia or something like that. What you're saying maybe is, and correct me if I'm wrong here, you're not actually looking to short that stock as it's towards what would maybe be a top of a range, or overextended to the top end of kind of a mean situation. You're actually waiting for it to kind of pull back to trend, if you will, and then buy it down there. Did I describe that correctly?
You did, and that would be a strategy for people that are newer to the marketplace. That strategy of mean reversion inside of a trend, I feel like works very well for people that are not as capitalized, obviously, as a large trading institution or hedge fund. As a hedge fund or someone with a lot of capital, for me, I may short it up there depending on how the stock looks. But I don't recommend that to people that are just getting started or new to this, because it's a very difficult situation to get out of when you're wrong, especially when you're shorting a name that is exploding up. I don't recommend that for people that are starting out. So what I would say to simplify it down is, let's say Apple runs up 10, 15%, like it's done a couple of times this year. It's up about 40% for the year, which is massive for Apple. But there have been pullbacks of 15% during this year that have been really, really good. So we believe the trend is still higher. But if we can catch a move back down inside of that trend, I think those are good opportunities for people that are in the marketplace, that are new, that are looking to get involved in this situation.
No, and that's fantastic. And what I would suggest is, or the question that I have actually is, I think that most investors can kind of visualize that, like an Apple or Nvidia gets a little overextended to the upside, markets get a little excited, and then the stock kind of sells off. In fact, we're seeing that more or less over the past maybe couple of weeks. Markets have kind of pulled back just a little bit. Is there a specific technical indicator? Is there kind of a group of indicators? Like what are you looking at that kind of triggers, like, here's the moment to get back in? Is it a technical indicator? I'm sure after all your experience, there's probably some feel involved, but for those that are at home just getting started, what indicator or what should they look for? So when Apple starts to pull back from those highs that it made, where is the entry point? Like, how do I know how to get back
Well,
into that stock?
well, if we're looking stock specific, let's look at Apple just for an example, just quickly, because people are probably aware. So Apple was making highs on the year about a week ago from when we're speaking. And then all of a sudden, this news came out with China. So it was a very bad news. Stock sold off about 15%. China said that they weren't going to allow the government to use the iPhone. And then it got to the point where they said they weren't going to be able to sell iPhones in China. So, you got to be leery of the news, and you can get hit by that news at any time. But underlying strength in Apple leads us to believe that you kind of want to be long or play that long. So that example, I would call a news example. So that's not really technical. That doesn't really have a lot to do with the charts, but that's basically news related. So that's that specific example. But there are other examples that are, very, very technical or chart centric. We might see a level in XYZ stock that we're like, listen, it's held this level 5 times. We believe that this is a good level to be long, and then we could get long and just trade from the long side in that name. So, there's a lot of different ways to attack this, but really, what's also happened, I would say 10, 15 years ago, the broad-based indicators that were external to the market, whether it be crude oil or bonds or currency, or we used to trade the Japanese yen tick for tick with the stock market, back in the 80s, that, went away. So, it's a lot harder now than it has been in the past to find the clues that make the market move per se. But overall, I would suggest finding something that you look at that's been really helping the market move up or down, whether that's the price of oil. I mean, right now it's a really weird situation because I would want to be really, really short the stock market because oil is about to break $90 a barrel. Interest rates have gone from 1% at the beginning of the year or lower up to 5.5%. These are all extremely negative things. But ironically, if you turn the stock market card and you said that NASDAQ would be up 43% and the S&P would be up 17, I'd be like, not a chance. So a lot of the clues are false clues, but you got to respect the market, for the time being.
No, and I think you highlighted something very well there. Like if we were sitting here last year, we would be maybe a month off the lows or we'd be actually approaching the lows in October. And if you would have told us interest rates would have just kept going up and, you would have had a mortgage interest rates coming into 7%, oil would continue to climb higher, we probably wouldn't be sitting here thinking that the equity markets would be having as great a year as they've had, particularly in the tech sector this year. And I think you really highlighted something very important, that you have to respect the markets, because there's a lot, we can all follow all the macro economists out there and they're telling you this should be happening, this should be happening, this should be happening, but the price action on the screen is saying something otherwise. And so respect the markets, respect the trend, I think is what I'm getting from you, Larry, is that, look, don't fight the trend. And I think there's an old saying, the trend is your friend until the bend at the end, if you will. And sometimes these very simple things absolutely hold true. Now, what I absolutely want to talk to you about is you've identified it, in my opinion, like a trade. I think you could be a veteran trader like yourself. You could be a new trader like somebody maybe watching at home. You know, you identify a stock that's in an intermediate or a longer term uptrend. You wait for maybe some news driven or some broad market pullbacks, and you pull the trigger on that stock. What I want to talk to you about is risk management, because we can be wrong, right? Apple can sell off 10-15%. We can enter the stock at, let's say, $140, and we can be wrong. Stuff can happen, obviously, with any stock, any sector at any time. How do you protect yourself to the downside? Or do you protect yourself to the downside in these situations, to where, and how important is that? So how do we, we have our trade set up, Apple's in a long-term trend, we bought it on the pullback, but for some reason, this time is different, whether it's news, fundamental, or whatever, this time is different, and the stock breaks down. How do we protect ourselves from losing our whole portfolio or a huge chunk of our trading money?
Well, the first thing I would say is you want to build up your P&L, or you want to build up your capital. So I would suggest when you're starting to be smaller than you want to be. So if you want to buy $10,000 worth of Apple, buy 5, okay? Define what you're willing to lose. So when I enter a trade, I enter the trade and I'm like, you know what? I'm in this trade, and the most I'm willing to lose, I'm making this up, but is 3 points. So whatever your number is, and then equate that to a dollar amount. Utilize a stop immediately. So when you put the trade in, put a stop order in, which is an order that automatically gets you out of the trade. Because a lot of times, as you become more veteran at this, you'll be able to maybe not use stops as much, because you'll be able to manually do it, although I suggest stops on all the trades. And then it'll exit you, and plus or minus a little, you'll only lose that amount of money. So the first step is not be as big as you want to be less, give yourself a little bit more room so you're not sweating bullets and you're going to freak out if the stock starts down ticking. It gives you a little bit more staying power. And then what we like to do is we like to build up our P&L, or build our stack up. So we'll buy Apple. Let's say the stock's 174. It came down from 180. We buy it. It trades to 176, 177. This is more for a trader. We would sell that stock out. We would take the P&L, and then we basically make our next trade. Now we're trading with positive P&L. Now you can move your stop a little bit lower because you have more money to work with. And then we try to do the same thing over and over and over again. And the next thing you know is our unit size, or our size of our trades, are increasing based on how our P&L is. We are never increasing our size when we're down money. We're decreasing our size. But when we're up money, it's basic money management. It's hard to put into play because trading, a lot of people can lose their discipline or whatever. But if you add to your position when you're doing well, and cut your positions when you're not doing as well, you will always end up much, much better. What I've seen in my years and years of trading, and I've managed probably, I don't know, at hundreds of traders, maybe thousands, but hundreds for sure. And the biggest mistake that I've seen is people were the biggest size or the most money in the market when they were down the most money. And that inherently would always happen. So really keeping your risk discipline, utilizing stops, okay, enter positions smaller than you want to be at the beginning, and then you'll have plenty of time. And once you get better at it and understand it more and are doing better, increase your size, utilize your P&L, and just as I always say, put P's or profits on the page day after day, and you'll be really in a good spot. But, I would say, the risk discipline is the most important, utilizing stops, being smaller than you want to be, and containing risk.
I mean, that's just discipline and patience, I think, are a big part of, the longevity and success that you've had over such a long period of time. And, and I think it's just such great advice to, as you're struggling, as things may be going against you, to reduce your size and pull back a little bit, and maybe take a broad sense of what's happening with less capital at risk. And I think the tendency is when we start to lose a little bit of money, we want to try to get it back as quickly. And so we start to put, people do this in the casino as well. They start to push their bets, if you will, and to resist that human instinct to do that and actually pull back, I think is just fantastic advice. So I think, Larry, we've identified kind of a trade opportunity that most people kind of identify. You got a longer term trend in a stock. It may have gotten a little overbought, and on some kind of news or technical, it starts to pull back. We buy it. We set a stop loss as well. I think the only thing that we haven't covered is when do we sell? How do we sell? How do we determine when to sell? Do we determine the price we're going to sell at when we buy the stock initially? Or is it kind of a fluid situation as that trade unfolds? Is that when we decide to actually sell the stock that we've kind of made a position in?
Well, I would say this, for newer people out there, I would definitely have what I call an out, or a price that you're going to sell, and stick to that. And I would put that in the machine or in your system, or if you trade at Charles Schwab or wherever you trade, just put a sell order in at that price. For me, I do it a little bit different, and I've been doing it a while. So like what I do is I use time interval or time frame. So if I get the move I'm looking for in like 2 hours, that may give me the ability to stay longer because the move happened that I was looking for really quickly, and maybe there is an extended move. But like for someone that's new, if my move happens, my average holding time is anywhere from 1 to 3 days, let's say. I'm always in and out of positions, but I may get long 8 times, in a row, but I'm looking to get in and out, not holding it. But I would say for me, I'm looking at, time interval, and I'm looking at how fast it's happening. And then I try to squeeze for a little bit more. But again, if that move doesn't come in a day or two, I'm just trading it like everyone out there would. I'm looking at my price point. I bought Apple at 174 and it's trading at 178. That's more than what I thought, and I'm out. That type of thing. So
my question is are you, so when you're in and you're out, is it kind of an all in or all out situation? Like if your Apple starts to pull back, and let's say you have $10,000 to put into it, are you executing $10,000 all at once, or do you do it in increments where maybe you do 3,000 and then another 1,000 and then another 1,000? Are you putting it all in at once and buying it and selling it in one trade, in one lot, or are you doing this in increments?
I would say it would depend on the scenario and how bad I wanted to, how bad I wanted to, own it. Most of the time I'm in on most and then out on most. So I don't average in. It's hard. Like what you're saying, I think is, hey, I bought 300 shares here, I bought 300 shares there, and I bought 300 shares lower. And I'm assuming you're saying buying it lower. So you start out here and then you buy it a little lower and a little lower. I don't like to do that, because then you own your whole quantity at an average of lower than where it's trading. And I don't like that. So I'm more all in or mostly all in, depending on the scenario, place my stop to get out in case I'm wrong, and then have an exit price. But, what you're saying, I think, is, hey, and a lot of people do this. It's called dollar price average. I don't like to trade that strategy, especially, listen, that works much better if you're an investor rather than a trader. Doesn't work that well for a trader. A trader has a problem, because if you buy here and you buy here and you buy here, and your last buy, you're bought, you're down money.
That's great insight, Larry. I've actually never thought about that, kind of that sizing perspective from kind of a trading versus an investing strategy perspective. I think that a lot of people are going to get a lot of great value out of that. Look, Larry, it's been wonderful to talk to you today. And I know that we're going to have you back on the channel. We're going to talk about more advanced strategies, option strategies. I know you're doing a ton of trading. I get all your emails, and it's coming from larrytrading.com. You want to tell the people at home a little bit about your service and maybe what they can expect from that?
Sure. So I started the Opportunistic Trader a little over 5 years ago. I had been in the business, it's coming up on about 40 years right now, mostly trading for large institutions and hedge funds. I had a hedge fund for a number of years. And then in about 2015, 16, I saw this niche in the marketplace where people were giving out information, education, and trade ideas to the public. And I thought, wow, you know what? I think I have a little bit more knowledge. I've traded at a very, very high level, and I think I would enjoy going out to the public and sharing my thoughts, insight, ideas, etc. And I put together the Opportunistic Trader, and then I hooked on to MarketWise, which is a public company, and they provide me with all of the stuff that I do outside of what I know about, which is trading. So they have the ability to get the reach to all of our customers. But so our product is mostly all options. We have some other products that we do some deeper investing for a little bit more high net worth people, but our main services are options to beginners all the way up to experts. We walk everybody through what we're doing. We've had a very, very high success rate over the last 5 years. Not one of our products was down money any year. Right now, we have one product of about 4 or 5 option products that we have that are down money, and we're clawing back, and I'm hoping that we could keep our record intact. But I think, like, especially last year, where it was very, very tough for a lot of investors, we really queued in last year. We were able to, what's great about our service is you're able to play the long side of the market or the short side. And it's very short term. So we could be in and out of positions, like I said, as little as inside of a day to a few weeks in duration. And last year was a tremendous year for us. This year, one of our products is doing really, really well. Our spread trading product, where we spread trade on the SPX. Our long option product, which is our signature product, is down money. But all of our other products are doing well. But the service, I really enjoy it. I enjoy helping everyone out there. I'm hoping that people we write a free news letter every single day, which has really good market insight, both fundamental and technical. So, it's been a lot of fun. So I hope people can find us, and I can keep providing this information to everyone out there.
No, and I love that, Larry. That's what I love about you is that you have all this experience, and you could be sitting back more or less kind of doing whatever you want. And you are helping new traders, new people. And I get your e-letter and I get your trades, and it's very easy to understand. And it's something that even somebody that's kind of new and kind of fresh, now you have like more or less like a mentor. You have somebody there that has the wealth of experience behind you, helping you. And I think it is one of the best ways to get into trading, especially if you're an investor already with like a retirement account or some money on the side in real estate or whatever it might be. This is a great way to trade some money that you might have and earn some income. And like you said, you've got products with just a great track record in up or down markets. I'll have links in the description down below if you want to join Larry and LarryTrading.com. I highly recommend that. Larry, I hope you enjoy the rest of your day. Thank you so much for joining us here on the Investor Channel. I hope you come back again and we can talk some more.
Oh, Colin, I greatly appreciate it. Thanks so much. It was a lot of fun, and I hope everybody is doing well and enjoy your day.
Thank you, Larry. Thank you so much. And it was a pleasure having you. Thank you.
Thanks. Take care.